So you have $100, not $1,000, not $10,000. You have $100 and you're wondering what actually happens when you invest $100 a month. And I'm going to tell you right now, you're not going to become filthy rich like Mark Zuckerberg or Elon or Warren Buffett. But what I will tell you is that if you start investing little by little now, even with just $100 a month, it's going to set you up for success down the road. And basically, this is exactly what I did as a former public school teacher. I started investing just very little in the beginning, and I did it with a lot of consistency, and I did it where I was very disciplined in making sure that I did it every single month. And that's exactly how I became a millionaire in my 30s. So I'm going to share my screen here. If you haven't done so already, you can download my study guides down below if this helps you learn a little bit better. But I'm going to tell you right now, the $100 is actually not the point. What the $100 starts is the actual point. What it creates, the snowball effect, the domino effect that comes afterwards, that is what is most important. So who is this video for? Who is this guide for? Well, if you're new to investing and you don't know where to start, maybe you feel like you don't have enough money to invest yet, or maybe you've been putting it off because it feels complicated or risky, or maybe you just want a simple and clear plan that you can actually follow, this is going to be the video for you. I'm going to go over basically the 5 components of what will happen when you get started with investing $100 a month, okay? So what you're going to actually learn is you're going to see what happens month by month and year by year when you invest $100 consistently, why starting small beats waiting to start big every single time. I'm going to run the calculations with you. The one mistake that wipes out most beginners' returns, which is very crucial if you are a complete beginner to the investing world, and how to calculate what your money could become later on. So let's talk about chapter 1. What happens in month 1? And I call this the identity shift. So when you get started with investing, it's very easy to do. I've done a lot of videos in the past. You can look around on my YouTube channel where you basically just have to choose a brokerage like Fidelity, Schwab, or Vanguard, which takes around 10 minutes, and you're just going to link up your checking account, set up your automatic transfers of $100 every month, the first of every month. And let's just say that you invest in something very simple, into a low-cost, broad-based index fund that tracks the S&P 500, something like SPYM, VOO, or IVV. Or if you want to check out other ETFs, VTI or VT, those are good options too. And then what you can basically do is click on confirm and then close the app. That's it. That's the whole move here. So what happens the next morning? I'm going to tell you right now, your life will completely look identical to the day before. Your account is still going to have $100 in it, and nothing is going to feel different. But here's what actually happens. You see, before last night, you were someone who intended to invest someday. You kept thinking about it. You kept wondering what would happen if I invested, right? And you kept waiting for the right time. You kept watching everyone else invest from the sidelines. But after you actually took action, what happens afterwards is, well, you actually transform into someone who actually invests, right? You now actually started. You are now in the game. And these are 2 completely different types of people right here, right? You are not the same person. You are not the same person who makes the same decisions. You now are making these different decisions. You're going to start noticing different things. And I will guarantee you right now, you will arrive at completely different places 10 to 20 years from now compared to your past self, right? So this right here is not just some sort of financial transaction. This is an identity shift. Okay, so here's something that's very interesting. So research has shown that the single most reliable predictor of continued investment behavior is just really getting started. I've worked with multiple people with getting their account set up, with getting them to start investing. And I will tell you, the day that they start is the day they have the biggest change because they actually took action. And it really is not about the amount or the return of the stock market or what the stock market is doing when you click on buy, okay? It is what? It's that you took action and that you have this identity shift. You're going to be this brand new person when you get started. So let's talk about what happens afterwards. So chapter 2. Month 6, this is where you're going to encounter the first emotional test. So you're going to freak out a little bit because more likely or not, the stock market is going to have this thing called a pullback or some sort of correction where the stock market drops. It might drop a couple percentage points and you're going to freak out. By that time, you would have contributed around $600 because $100 times 6 months is $600. So when you open the app and there's some sort of market correction, a market drop, you're going to notice that your balance might not say $600 anymore. It might say something like $567. So you're basically down $33 on paper, right? These are unrealized losses. And I'm going to tell you right now, like this happened to me when I first started investing. This happens to a lot of my community members when they first start investing. Your gut is going to tell you that something is wrong, that you probably made a mistake, that you shouldn't have invested in the first place. Okay, so really, this is where there are going to be two paths in front of you. So this is what most people do. They will panic and they're going to sell everything, right? They might start to move their money to cash and they're going to wait to feel safe. They're going to then have a little bit some regrets because what eventually will happen is the stock market will go back up, it'll recover, and then what's going to happen is they're going to miss the recovery entirely. So I'm going to show you some stats in a little bit. And then what happens is because they see the markets go back up, they're going to get FOMO, right? Fear of missing out. And then they're going to start buying back at a higher price than they sold. And then they're going to continue to repeat the cycle every single time there's some sort of downturn, there's some sort of market correction. This is the person that you don't want to become. This is the path that you do not want to go on. What you want to do instead is the second column. You're going to look at that $567 and you're just going to close your brokerage app. That's it. Ignore it. And you just want to remind yourself that, hey, you're investing for the long term, not for 1 day or 5 days or for a month or for a year. You're doing it for the next 10, 15, 20 years or so. You are a long-term investor. So you want to stay invested, and just keep buying a couple more shares every month. You're going to keep doing this thing called dollar cost averaging, because what's going to eventually happen is that the markets are going to recover while you still own your shares, and that's where building real wealth actually occurs. You want to stay invested. So this is a table right here that shows the cost of trying to time the markets, because I see this over and over again with a lot of beginners where they try to time the markets right at the bottom, right when there's a bottom drop, and then they try to purchase at that moment and they try to sell their shares at the very, very top. And I'm going to tell you right now, no one can time the markets to a T. No one. Okay. So this shows you right here that if you were to just miss the 10 best trading days, you basically cut your returns in half over a 20-year period, right? Pretty scary, right? Cut it in half. And if you just miss these days, you will just affect your entire portfolio because you then interrupt the compounding effect. And this is something that you don't want to do. You want to what? Stay invested. That is the overall message for this video here. So chapter 3. So let's talk about the actual numbers year by year and do a comparison. So if we were to assume that you are investing now into something like the S&P 500, you're getting an average 10% annual return, which the S&P 500 has given over the past several decades, and you're investing the $100 a month. Well, guess what? In year 1, you're going to have put in around $1,200. Not bad. Your balance, when you look at your brokerage app, is going to say around $1,265. You basically gain $65 of compound growth just by letting your money work for you. Now, this is the part where it doesn't feel so big, right? There's no dramatic gain. Everything feels very small, but that's okay. That is normal, okay? It happened to me. It happened to my community members, my family, my mom, my dad, all my cousins, right? This is what is supposed to happen. However, if you skip over to year 5, take a look at how much money you have put in. Because you were consistent, you were very disciplined with investing, well, you would have put in $6,000 of your own money. Now your balance is going to be around $7,800. You basically made a gain of $1,800. So it's starting to grow right now. And by this point, you would have been earning around $65 a month just by itself, just by letting your money work for you, right? Very cool. If you fast forward to year 10, you would have then contributed around $12,000 of your own money. But when you look at your portfolio is now going to say that it's going to be around $21,000 for, just by being invested. Right? There's a big difference now. You basically now have an $8,400 or maybe around a $9,000 gain, right? So the market is now doing more than 40% of the work this year. Pretty crazy, right? And this is where the magic happens when you're about to hit what I call the crossover moment. So the crossover moment usually comes by year 12 to year 13. This is where you would have put in around $15,000 to $16,000 of your own money. You look at your brokerage app and you would now have around $27,000 in it. And guess what? The crossover moment then happens. Basically, your annual returns now exceeds what you're actually contributing, right? The machine starts running itself. Because if you think about it, if you're making now $11,000 to $12,000 gains per year, well, that means that you are generating around $100 a month. And that's what you actually started off with, where you were putting $100 a month. Now the market's your portfolio, because you were very patient, you're very consistent. Now it's generating $100 a month. If you fast forward to year 20, this is where the compound growth gets even bigger. You would have put in around $24,000 of your own money, and now your portfolio, your balance would be around $68,000 to $69,000. Fast forward to year 30, keep it up, you now would have a portfolio of around 197, very close to $200,000. So essentially the math works out to this. For every $1 that you contributed, the market added another $4.48. Isn't that crazy, right? This is where you have this shift of, instead of just working for your money, you are now letting your money work for you. Now, I know the next question is, and this is where we get to chapter 4, what if you invest more? Okay, so here is the take-home message, right, that I've been trying to hammer down. The variable that really matters the most is not the amount, right? That not really the $100. It's actually the time. The more time you have in the markets, the more your portfolio is going to exponentially compound and grow over time. Okay, and this is really how all wealthy people do it. All of their wealth grows not in a straight line, like what a lot of people where they don't know how to invest. It actually grows in a J curve where it just shoots up, right? So let's say that, okay, Steve, I am able to invest a little bit more than $100 a month, because that's what's going to naturally happen, because you are now recognizing the power of investing over the first 1, 2, 3 years. It's going to make you more conscious with how you're directing your money. You're going to say, hey, maybe I can cut back on this. Maybe I don't have to go out to eat that much for this weekend or this day. I can maybe cook more, or maybe I don't really need that extra Amazon purchase, or Amazon Prime is coming up. Maybe I don't need to go into the sale and purchase anything. And it's also going to encourage you to say, well, maybe there are some other opportunities in my life where I can increase my earnings, right? I can make more money. So this way I can get more of my saved money, more of my earned money, and then contribute it into the stock market. So if you were to invest $100 a month, well, you would have contributed around $36,000 over the span of 30 years, meaning that your balance with a 10% average annual return, your balance would be around $197,000. Not bad. But what if you invest $200 a month? Well, this will give you around a portfolio of around $395,000, very close to $400,000. If you were to invest even more, say $300 a month, well, this means that you would have close to $500,000 to $600,000 by 30 years, right? And if you were to increase this even more to around $500 a month, this means that you would have a portfolio very close to $1 million. And I know for some people who are just starting off, they might think, wow, $300 a month, that sounds like a lot. But if you break it down day by day, that really equates to around $10 a day. So if you can figure out a way where you can save $10 a day, or you can maybe earn $10 more per day, then this is very achievable. This is absolutely doable. And same thing with the $500 $12 a month. This really equates to around $15, $16, $17, $18 a day, right? If you can do that, then you are able to achieve that $1 million mark later on. So here's the thing, folks. I want to talk about the cost of waiting, because a lot of people will say, Steve, I don't feel ready to invest yet. I'm going to invest later when I make more money, or, when I hit XYZ goal, some sort of ambiguous goal here. But I will tell you right now that if you start at the age of 25, right, and you start putting in the $100 monthly contributions, in the next 30 years or so, you would have put in $36,000, yes, and your portfolio would be around $200,000. If you wait just 10 years until you're 35 years old and then you start investing, you know what? You won't be able to just invest $100 a month anymore to get the same results. You would now have to increase your contributions to $300 a month. Right? So you basically have to triple that amount. So this way, in the next 20 years or so, right, then yes, you would have contributed more, obviously, $72,000. And guess what? Your portfolio bit would be around the same amount, around $206,000, $200,000, similar to person A right here. So person A basically was able to get a 10-year head start, even though person A was contributing less money per month, right? So what's the lesson here? Even though you feel like you are not earning enough or you're not saving enough, you don't have a lot of money, it's okay. Start small. Start small, even if it's just $25 a month or $50 a month, right? Just start small, start now, because later on, you're going to see that compounding effect, okay? All right, so here is chapter number 5. What actually changes when you start investing the $100? So here it is. The obvious answer is, of course, your balance grows. But what changes more, what is a bigger impact, is that you are what? More conscious of where your money is going. Because I will guarantee you right now that once you start investing, you're going to see the positive effects of investing, and you're going to say to yourself, gosh, Steve, I wished I started earlier. Everyone that I work with a lot of 40, 50-year-olds, and they all tell me the same thing. Steve, I wished I started earlier. Okay? If you're young, in your 20s and 30s, listen, okay? Let's get started right now, because the most expensive financial decision that you will make is waiting, okay? You don't want to have this thing called opportunity cost, where you wait and it's actually going to be a bigger cost to you later on. It's like you have a broken bone and you don't want to go to the doctor to check it out. If you keep waiting, it's going to get worse and worse and worse, where the medical bills will actually be even more later on. So you want to acknowledge the problem right now. You see that you need to be investing right now and start today. Don't put it off. All right. And then what's another thing that will happen? Well, you're going to start understanding why everything that you see on social media, where people will say, pay yourself first, pay yourself first. Like I say that all the time, pay yourself first. Why this phrase is so important, that every single month or so, when you get started with investing, the number one bill that you want to pay is the U bill, is the future U bill. That is the bill that you want to pay, not Netflix or Amazon or your phone bill. I mean, of course, these are important, but the most important bill that you want to pay is a future U bill, okay? The future U company, all right? You're going to start seeing that every dollar is something that you can grow, that can work for you, that can duplicate over time, right? That can become even more money over time. Or you're going to see that every dollar is just this thing that just disappears, right? So you want to make sure that you are putting your dollars to work. And this is what all wealthy people do, all right? So you can see the $100 monthly investment kind of like you putting your money into some sort of financial education class. But the big difference here is that you are actually getting paid to learn, right? The tuition is, the school is actually paying you instead. You're not paying the school. They are paying you, where your money is actually growing, right? So it's such a win-win opportunity. You are learning about the stock market. At the same time, you are also growing your net worth. All right. So here are the next steps for you, because I am a teacher. If you are someone who says, Steve, I want to get started with investing, but I don't know how, then it's absolutely okay. I know investing is very scary. It's very confusing, especially for a beginner. I was very confused. I was very intimidated, but what you really need is just a clear plan. So if you haven't done so already, I highly encourage you to download the free investing roadmap down below. I have a whole bunch of calculators in here, step-by-step tutorials that I spent so much time putting together. I screenshot everything here where I show you step-by-step on what to click on in your brokerage app. Like I put these little red rectangles here, what ticker symbols to type in. I put in all of my favorite ETFs, all right here, right? All of the expense ratios. I even give you a table on figuring out how much you need to retire. I have a compound interest calculator here. I spent hours and hours and hours creating this just for you. So go ahead and download the roadmap. I promise you it's going to change your life. It's going to really help you get started. And the next thing is I highly encourage you to join my beginners investing masterclass, where I go through step by step on how you can get started with building a simple, easy 3 ETF allocation system for your portfolio. Okay, you don't need to complicate it, because I know there are a lot of finance gurus out there that say that you need to invest in this stock, this ETF, this mutual fund. I cut through all of the confusing jargon and I just kind of give you a simple framework that you can follow, and that basically I follow myself and how I became a millionaire myself. All right. So if you are interested, go ahead and download the roadmap. I hope this video helps. Let me know your thoughts in the comments down below, and I will see you in the next video.